Imagine this picture. $9,000 every
Right.
single month, just appearing in your account.
Like clockwork.
Exactly.
Yeah.
Not from the 9 to 5 grind, not from selling stocks, but purely from dividends. It sounds, well, pretty appealing for retirement, doesn't it?
It really does. And especially now, traditional safe bets, they're not paying much. The market's been a bit wild.
Right. So this idea of generating your own income stream through dividends, it's getting a lot of attention.
For good reason.
So that's our deep dive today. We're digging into some material to figure out, realistically, how can you take a $1 million portfolio
$1 million, okay.
and turn it into $9,000 a month in dividend income?
Mm.
That's $108,000 a year.
Okay.
And look, this isn't some get-rich-quick thing we're talking about. It's a specific strategy focusing on certain types of assets known for higher yields.
And it's important right up front to be realistic about what that takes. That kind of income is fantastic, obviously. But getting there means understanding the yields and, frankly, the risks involved.
Okay, let's start with the basic math then. $1 million aiming for $108,000 a year. That works out to a portfolio yield of 10.8%.
Yeah, 10.8%.
Yeah.
And straight away, that's quite a bit higher than what you get from, say, just buying an S&P 500 index fund.
Or even many standard dividend stocks.
Absolutely. You're not hitting that number with just, the classic low-yield, steady growth dividend pairs alone.
So, you have to look elsewhere. But the sources we looked at are clear. Don't just blindly chase the highest number you see.
That's a huge trap. Sometimes those really eye-popping yields, the ones that seem too good to be true,
Yeah.
they often are. It can signal deep problems within a company. Maybe the dividend's about to get slashed.
Which is the exact opposite of what you want if you're aiming for reliable income.
Precisely. So it's not just about the yield percentage. It's about building a balanced portfolio, understanding why the yields are high.
Okay, so how do you build it? The material lays out a kind of blueprint, dividing the $1 million across different asset classes. First up, REITs, real estate investment trusts.
REITs, right? These are a cornerstone for a lot of high-yield strategies. And a key thing about them, structurally, is they have to pay out most of their taxable income to shareholders. Like, it's a rule, usually 90%.
90%. Okay, so that naturally pushes income to investors.
Exactly. The examples mentioned, like AGNC Investment Corp, that one has a really high yield, around 14%.
Wow.
Then you've got Realty Income, people call the monthly dividend company. Its yield is closer to 5.5%.
More moderate, but still solid and monthly.
Right. And Omega Healthcare Investors, Ohio, around 8.5%. So you see a range even within REITs. The plan suggests putting 35% of the portfolio here.
35%? That's a big chunk.
It is. It shows how much income potential they see there. But, you need to consider things like what kind of properties they own, vacancy rates.
Yeah.
That affects the dividend safety.
Makes sense. Okay, after REITs, the next slice is 25% in BDCs, business development companies. What exactly are these for anyone who hasn't heard of them?
Good question. So BDCs, they basically lend money to or invest in small and medium-sized private businesses.
Okay, companies that maybe aren't big enough for traditional bank loans or public markets?
Often, yeah. Or they need specific types of financing. BDCs fill that gap. And like REITs, they tend to pass through a lot of their earnings as dividends.
Gotcha.
The sources mentioned Main Street Capital, Maine, yield around 6.5%, and Eris Capital, RRCC, which is higher at about 9.5%.
So again, a range contributing significantly to the overall yield goal, putting a quarter of the portfolio there.
Yeah, it shows confidence, but you have to remember, lending to smaller private companies has its own set of risks compared to, say, buying stock in a huge public company.
Right. Due diligence must be key for them.
Absolutely. Understanding the quality of their loan portfolio is critical.
Okay, moving on. 15% allocated to energy infrastructure. We're talking midstream here, right? Pipelines, storage.
Exactly. The toll road model of the energy sector, essentially.
Why are these seen as reliable dividend sources?
Well, think about their business. Transporting oil and gas, storing it. A lot of their revenue comes from long-term contracts. Fees for using their pipelines or tanks.
So fairly predictable cash flow.
That's the idea. More predictable cash flow often means more reliable dividends.
Yeah.
Examples given were Enterprise Products Partners, EPD, yield around 7.3%.
Okay.
And Magellan Midstream, MMP, which had an 8% yield. Now, it got acquired, but the point is similar midstream companies exist.
Got it. So steady eddies in a way based on this contracts. But are there downsides? Like what if energy demand shifts or regulations change?
Definitely risks to consider. Regulatory changes, environmental concerns. Even just shifts in where energy is produced or consumed can impact them long term. It's not risk-free.
Understood. Okay, this next one's interesting. Covered call ETFs. 20% of the portfolio. How do these actually work to generate income?
Yeah, these are a bit different. They use an options strategy. So the ETF owns a bunch of stocks.
Like, say, the stocks in the NASDAQ 100.
Exactly. Could be. Then it sells call options on those stocks. Selling the option generates cash up front. That's called the premium.
Okay.
And that premium income is what gets paid out to the ETF shareholders as dividends, boosting the yield.
I see. So the examples, QYLD, the Global X NASDAQ 100 covered call ETF, yield around 12%. That's high.
Very high. And JEPI, the JP Morgan Equity Premium Income ETF, more in the 7% to 9% range often.
But what's the catch? If you're selling the right for someone else to buy your stocks, do you miss out if the market goes way up?
That's the trade-off, precisely. By selling the covered call, you cap your potential upside. If the stocks soar way past the option price, you don't fully capture those gains because you essentially agree to sell them lower.
Right.
You get the premium income instead.
So you're trading potential big gains for a more upfront income.
Got it. That's the core exchange.
Okay. And finally, the last slice, just 5%, is for sleep well dividend stocks like Johnson & Johnson or PepsiCo. Lower yields, maybe 3%.
Right. These are your classic blue chips. Big, stable companies, long history of paying dividends, usually growing them too, just maybe not super fast.
So why include them if the yield is low compared to everything else?
They're ballast, stability, less volatility. The idea is they provide a reliable foundation, even if they don't juice the overall yield number as much. It's about adding a layer of, well, sleep well predictability.
Okay, so let's put it all together then. Based on the sources model, 35% REITs, averaging maybe 10%, 25% BDCs at 8%, 15% energy infrastructure at 7%, 20% covered call ETFs at 10%, and that 5% in blue chips at 3%.
Add all that up, weighted by the percentages.
And you land pretty much smack on that 10.8% blended yield target.
Yeah, the math works out on paper to hit that $108,000 annual income.
Which gets you the $9,000 a month. It does paint a clear picture.
And you see the diversification, right? Different engines driving the income: real estate, private lending, energy tolls, options premiums, stable corporates. Each has different risks, different dynamics.
That blend is key, you're saying.
Absolutely critical for managing the overall risk. You don't want all your eggs in one high-yield basket.
But it's not set it and forget it, is it? The source stresses you need to actively manage this. Reinvest, rebalance.
Oh, definitely not passive in that sense. You've got to monitor things, like the payout ratios. Is a company paying out way too much of its earnings as dividends?
Like 100% or more, that's a red flag.
Huge red flag.
Yeah.
Could mean the dividend's not sustainable. And reinvesting dividends you don't need right away, that's huge for growth, compounding.
Right. And rebalancing. Selling winners, buying laggards to stay on target.
Yeah, keeping those allocations roughly where you want them. Say if REITs have a huge run-up and become 45% of your portfolio, you might trim them back to 35% and put the money into something else that's underweight.
And they mentioned a sector limit, like no more than 40% in any one area.
Good diversification practice. Avoids being overly exposed if one sector tanks.
Makes sense. Then there's taxes. That $9,000 a month isn't all take-home pay.
Nope. Big consideration. Dividends are taxed, but how they're taxed varies.
Okay.
So qualified dividends, often from regular stocks like, say, PepsiCo, usually get taxed at lower capital gains rates, which is good.
Right.
But dividends from REITs and BDCs, they're typically taxed as ordinary income. Same rate as your job earnings.
Ooh, that can be a much higher rate for many people.
It can. That's why the source points out holding those REITs and BDCs in tax-advantaged accounts, like a Roth IRA, can be really beneficial. Potentially tax-free growth and withdrawals in retirement.
Okay. But definitely complicated.
Yeah, very much depends on your individual situation. Talking to a tax pro is almost always a good idea with this stuff.
Good advice. What about common mistakes? The source highlights pitfalls to avoid when you're building this kind of portfolio.
We touched on the biggest one, chasing yield blindly. Just picking the highest number without looking deeper.
Right, the too good to be true scenario.
Exactly. Another one is poor diversification. Putting too much into, say, just mortgage REITs or just energy pipelines. If that sector hits trouble, your income takes a big hit. Also, not properly checking dividend safety. Looking at the payout ratio, the company's debt, their history, is the dividend secure?
You got to look under the hood.
You do. And finally, forgetting about inflation. A 10% yield sounds great today, but what will that $9,000 buy you in 10 or 20 years?
Good point. Does the dividend grow?
That's where looking for companies that increase their dividends over time comes in, even if the starting yield isn't astronomical.
Which actually leads to another point. The source brought up this idea of dividend growth investing as an alternative.
Yeah, it's a different philosophy, really.
Like Microsoft. Yield is tiny, maybe 0.8%, but they hike their dividends significantly almost every year.
Exactly. The idea there isn't high income now. It's that the dividend payment itself grows rapidly over time. It snowballs.
So you might start with a small income stream, but 10, 20 years later, it could be huge.
Potentially, yes. It's a longer game. If you need $9,000 a month today, the high-yield strategy we've been discussing is more direct.
But maybe you could blend them. Have some high yielders for current income, some growers for the future.
Absolutely. Many investors do exactly that. It depends on your timeline, your income needs, your risk tolerance.
So wrapping this up, this goal, $9 a month from $1 million via dividends. Realistic, aspirational. What's the verdict?
Based on the sources, I'd say it's
Yes.
realistically achievable, but with caveats.
Okay, like what?
Like, you need careful research. You need that diversification across the right kinds of high-yield assets, REITs, BDCs, etc. You need ongoing management. We absolutely need to understand the risks and factor in taxes.
So not easy money, but possible with a solid plan and execution.
Exactly. It's about building that freedom portfolio, focusing specifically on cash flow generation.
And what about for listeners who maybe don't have $1 million sitting around right now? Is this just academic?
Not at all. The principles are the same, whatever the amount. Focusing on income, understanding yield, diversifying. That works at any scale.
And the idea of getting to $1 million?
Well, that comes down to the long-term stuff. Consistent saving, investing wisely, letting compounding do its magic over years, decades even. It is possible. Starting small, focusing on building that dividend income stream, that's a powerful path.
The source even gives like 3 quick things someone could do today to get started.
Yeah, simple steps. First, open a brokerage account that lets you reinvest dividends automatically for free. DRIP, Dividend Reinvestment Plan.
Okay, harness compounding.
Second, do some research. Maybe buy a small starter position in one of these high-yield areas we talked about. Something you understand and feel comfortable with.
Dip your toe in.
Right. And third, set an actual goal for your dividend income over the next year. Even if it's just a few $100, having a target makes it real.
Start thinking in terms of income generated, not just portfolio value.
That's the mindset shift.
So the big takeaway seems to be that vision of significant monthly income from dividends. It's not a pipe dream. It's a potential reality, built strategy by strategy, focusing on cash flow.
Building that freedom portfolio.
Yeah. Definitely something to think about, the power of focusing on dividends, maybe explore some of those initial steps, dig into those asset classes. It could really change how you look at your investments long term.